Welcome to the Commercial Real Estate Show, your source for market intelligence, forecasts, and success strategies. Hello, I'm Michael Bull. Thanks for joining us on one of the radio stations, iTunes, YouTube, or the show website, commercialrealestateshow.com. Well, today we have a cool show for you. We're going to talk about the office market. We're going to see how 2016 wrapped up, what to expect in 2017, and moving forward. We're going to look at property performance levels. We're going to look at cap rates. We're going to look at REITs. And we're going to look at tenant strategies and some tips on some technology for your office properties. Please welcome my first guest is Walter Page. Walter's Director of Office Research at CoStar, and he's joining us on the phone. Walter, thanks for being with us.
Thank you, Michael.
So, Walter, what happened in 2016 in the office market?
Well, 2016 was a good year. It just wasn't quite as good as 2015. I think 2015 is going to go down in the record books as being the best year of the real estate cycle for all property types. But 2016 was really good. The highlight was we reached a business cycle high for occupancy, or a new low for vacancy. The vacancy ended up the year at 10.4. That was down from 10.7 a year before, and it's well below the long-term average of 11.3, so that's good news. Rent growth for the year on a nationwide basis was 3.2%. That's well over 2.1% inflation that we had over the last year, but it's down from 4.4 in 2015. Part of the reason why we had lower rent growth was we had construction, and that construction was capping the rent growth, especially in some of the tech markets and energy markets. A market like, for example, San Francisco, which had been going at nearly 20% rent growth, the CBD has slowed to less than 4% rent growth over the past year. Obviously, Houston is also seeing a slowing in rent gains and actually probably some declines in that particular market.
Okay, so 3.2% rate growth overall in the U.S. So how does that compare to historic numbers for rate growth in the office market?
Okay, so at the last investment cycle back in 2007, we hit over 8%. Mm-hmm. So this investment cycle peaking out at 4.4 and getting 3.2 over the last year, clearly less than we had last time. But you also have to remember we have less growth and we have less inflation. So it's still a very solid number, just not as solid as some of the historical numbers at this point in time.
Okay. What about the different classes, Walter?
So the flight to quality is continuing unabated, and it's actually quite amazing. Currently, the top quality space, which we call 4 and 5 star or Class A, is growing at a demand rate of about 1.8%, which is more than double the lesser quality space, which is growing at 1% or less. Now, what's interesting about this is that in this particular cycle, the lesser quality space, the B-type space, in the last cycle was performing very similar to the top quality space in terms of net absorption. This time there's a really wide gap as tenants really want nice space, and the demand is totally there.
Right, and everybody's hoping that they have a good economy ahead of them. They want some nicer space, right? So what about CBD versus suburban? Any differences there?
Now that one is really interesting. Historically, you look back at CBDs, or at least in this recovery, CBD market had been getting 1 to 2 percentage point higher rent growth than the suburban markets, and that number is shrinking tremendously. It's basically the same now across the markets. And what's interesting about that is the cause. In the CBD markets, we've had a disproportionate amount of new construction activity. So, for example, in Chicago, 75% of the construction activity is focused to downtown. That's double the fair share. Well, we see that same thing happening in Seattle, Denver, Washington, D.C., Los Angeles, which is just amazing, even Philadelphia. So, that concentration of construction to the downtown market and just the level of construction that's starting to increase across the board is leveling the playing field across the various markets.
Right, that's interesting. So it's really helping these suburban properties perform better.
Yes.
Okay. And so you mentioned new supply. What are the levels of new supply out there today?
All right, we currently have 138 million square feet of office construction underway. That's up from about 130 million square feet from a year ago. Across the markets, the market with the most new construction underway today is New York, 19 million square feet. But on a percentage basis, the market with the most new construction is actually San Jose. They have 10 million square feet underway, representing 9% of stock. The level of construction that we have right now represents about 1.6% of stock. At the other end of the construction activity, you can go to a market like San Diego, and we only have 0.4% of stock underway. So huge differences in the amount of construction happening across the markets. And roughly two-thirds of the markets have construction activity that is above the historical averages.
Okay, we're talking with Walter Page at CoStar about the office market. So, Walter, what's all that mean for projections moving forward? What do you expect for performance in the office market in this year and moving forward?
So we expect relatively flat to improving vacancy levels over the next 2 years. So right now we're at a 10.2% vacancy rate. We think that the market will bottom out at about 10.2 from 10.4. In sometime in 2018. So that means that there's still a little bit more recovery time in the market. We expect that the rent growth last year was 3.2, should be between 2.5 and 3% for the next, let's say, 3 years. And in general, we expect a fairly normal market with supply and demand in balance and things working pretty well. The exception probably will be Houston because of the energy bust that's happened down there.
Okay, so slightly less rent growth. So what are some factors that may impact the office market moving forward? Is there any change in your projections for office demand from the Trump presidency? I think it was a surprise to a lot of people that he won. He's talking about potentially reducing corporate tax rates. Does that maybe mean more jobs, which is great for office market?
We really don't think that there's going to be huge changes to real estate demand just because of the Trump presidency, although it could happen in particular locations. So, like, one of the factors that we're hearing about is more defense spending. The number one market for defense spending is suburban Washington, D.C., which is a market that has been not performing very well. So that could be something from the Trump presidency. The other trend that we see from the Trump presidency is a rise in interest rates. And that rise in interest rates could have an impact upon pricing and things like that going forward.
Right, yeah, that'll be interesting to see. Well, are there any certain markets that are having troubles or markets that maybe surprise you that are doing so well?
Well, let's focus on the positive first. Some of our favorite markets are generally in Southern California and Florida. That's principally because of a lack of construction activity. I would fill that in with a little bit more of markets like Nashville and Minneapolis and Boston also look really good. Where we have concerns is generally where there's a lot of construction activity. So, for example, in Washington, D.C., where they have over a 14% vacancy rate, which is really high by their historical standards, they have 10 million square feet underway today.
Wow.
And that would be a concern for us.
Right. Well, that's interesting. It'd be interesting, too, to see what happens, what Trump's able to do, and how that impacts the economy, how it impacts jobs in the market moving forward. And stay tuned. We're going to talk some more with Walter. We're going to talk about cap rates and what to expect moving forward there. We have rising interest rates, maybe improving economy. We'll see. Stay with us. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. Hey there, thanks for checking out the Commercial Real Estate Show. Don't miss a video of special interest to you. Be sure to subscribe below. And if you appreciate the videos, be sure and thank our sponsors. There's a link to more information about them in the description. For more videos, podcasts, and articles, check out CREshow.com.